this right here, that inefficiency trading right into that, that is a swing setup. That's a swing trade. And what would you be aiming for? You'd be aiming for the run below that low here. In longer term, you would leave your stop loss above this high. This is what makes long-term swing trading very difficult, because you have to allow the market to go into profit and then be willing to see it go back against you. So as a long-term swing trader, for those that are listening, if you want to have some notes on this, in swing trading, you want to try to build in a position slow. And when it gets to a higher time frame discount, if you're short, like we're seeing here, this is where you would take some of the short off, waiting for it to potentially give you another reversal so you can add it back. And that would be inside of this area right in here. There's your fair value gap. And inside that fair value gap, your stop would be above here, never moving it. You cannot move it. You have to leave it there. And it's scary. That's why swing trading, you think that you're avoiding risk by not trying to get in these lower time frame charts, when that's the best place for you to learn, because it'll teach you stop place management. It'll teach you patience. It'll teach you no fear of running out of setups. It'll teach you that your model works. It'll give you more in the trenches experience of reading price real time than any other time frame. But in swing trading, if you're trading with a daily chart, you cannot make a move of moving that stop loss to break even, trailing it to lock in target, a profitable exit. All you're doing is ensuring that you're going to get stopped out prematurely before your objective is met, because there's a lot of give and take on a daily time frame, unless that you have timed your entry, which you're not going to do this in the beginning. It's going to take you years. So on swing trading, in this instance here, if you're watching price, you would see this fair value gap here on the week of September 5th, knowing that it trades up into that. That's a setup. You can get short there. As a trader that doesn't use intraday price action, the way you would do this is on this, okay, here. Now, also trading on a daily chart like this, that means your leverage is going to be extremely low. Trading with a daily chart, you want to trade with the leverage, lowest leverage, that'll allow you and to afford you the ability to trade with a idea of selling. Listen now, you're going to sell weakness as a swing trader. If you can't watch intraday price action, that means you absolutely must, one of two things: either get up during the day and look at London and wait for a run that would be, in other words, in this area here when it was trading up into this price point here, you have to get up on the day that you want to try to enter on your swing trade, which would be here, here, or here, any one of those days. And you have to allow for a stop loss that's above this high right there, because you're swing trading. And you would sell a run below this day's, whatever that opening price is. You can use the settlement price here on TradingView. You can use, in my opinion, I would be using the midnight opening price in New York local time. If it trades below that, you'd be selling short. You would sell weakness as it breaks away from that inefficiency and goes below this candle's low. So your trading wouldn't really begin until this day here, because the open on this candle is down here, which makes no sense, right? Because you're too far away from the fair value gap. This is the first day that sets you up as a non-intraday, non-minute, second, 15-minute, 1 hour, 4 hour, anything less than a daily chart you can't enter on. So you're going to trade with a whole lot more patience required, a whole lot less leverage, and your stop losses are going to be absolutely enormous compared to what you see me using. But the logic is still the same, because if this was a 5-minute chart, or if this is a 15-second chart and this was the fair value gap, I would tell you that the stop loss needs to be above here anyway, because this is the candle that makes what? The inefficiency. So your stop loss has to be above here, because all you need to know is whatever this opening price is here, or whatever the opening price is at midnight that day, and the next trading day here, wait until after 9 p.m. the next day. Why? Because now you have Asian session in place. If it trades below that, you're short. Your stop goes above here. Whatever the leverage is required to allow you to do that and not risk more than whatever you're comfortable with, never more than 1%. But once this setup here forms, in this day here, you'd be selling short on weakness. Guess what that means? That means you can sell short on a stop. That means you're putting a stop loss that would put you in the trade. It's not stopping you out with a loss. It's a sell stop at this candle's or that day's opening price, preferably midnight. I use midnight New York local time. So as long as price on the next day was above it here, who cares? You're not interested in that. At some point, it's going to trade below that level here, and that stop order will become a market order to sell short. And then your open order for shorts needs to be protected with a stop loss above here. This would be a first partial. You can put multiple trades on, folks. Down here, you take off one of them. Then, because we see this big run down into this low, it creates a potential inefficiency, which is confirmed when this candle right here on the September 5th, once it closes that high between this candle's high and that candle's low, we have an inefficiency. So you can take and add inside this inefficiency, whatever you took off as a partial down here, you can add it back when it trades up into here. But look at this heat right here, ICT. It doesn't matter. You're anchored with your core entry up here, and your stop still remains right there. Can you swing trade with that logic? Because if you can't, then swing trading is not going to work for you. I'm just going to save you a whole lot of time. That is how it is. If you do anything apart from that, you're going to get stopped out a lot. You're going to take more losing trades. You're going to have a lot of failed launches with your setups, and you're going to be really impatient. And all of those things are going to coalesce into a tapestry that will keep you from being profitable, and it'll just make you want to quit. But you can add it back here, and then once we break below here, you can take another partial, or between this low and the next level down here, that would be, again, that weekly level. Between this low and this low, where do you take partials at ICT? Whenever I see two targets like this, I'd like to take that and divide it into quarters. I'm projecting an implied dealing range. That means I'm anticipating that this low will break and reach down here. But in this low and this low here, if you take your fib between this low here and this low down here, this, as prices up here, if it breaks this low, go back and listen to it, folks. I say these things. Then if it gets animated, that means it's going to really start to move lower. Then this is where you're going to be looking for. And overall, down here, if it gets overzealous. If this is an implied dealing range, it means the price hasn't been there yet. It hasn't gone down there yet. So I'm implying that the price can reach down there. That's what my analysis is suggesting to the viewers that watch my commentary. So if that's the case, then where can I take partials? So from this low to that low here, I've broken that up into 4 equal parts, which is a wonderful area to take what? A partial here if it reaches it, partial if it goes halfway, another partial here. So right now, you should be about 75% booked in profit from anything that you've been short from up here when we were up here. Even if you have to go through a whole lot of acrobatics and have wide stops, if you can catch 250, 300 handle runs, those things add up over the course of whatever amount of time is required for you to decide if it's worth it for you to invest more time, more money,